Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Today, we're diving into the dynamic world of fintech, and specifically a company that's really been making waves, SoFi Technologies, Inc. You probably know the ticker, SOFI. We've got a really in-depth analysis lined up. It lays out everything from SoFi, well, surprising strategic transformation right through to its financial health. And maybe most importantly for you listening, what it all means for its stock. Our mission today to unpack SoFi's journey, how it went from being a niche lender to this diversified digital bank. We'll explore the core investment thesis, weigh the opportunities against some very real risks. By the end of this, you should have a clear understanding of this pretty intricate player in financial services, maybe even hit that aha moment about its true potential. Okay, let's dive in. So let's kick things off with the big picture. SoFi, everyone knows, started with student loans, but this analysis highlights a truly massive transformation. What's the fundamental shift that we really need to get our heads around about SoFi today?
Yeah, and what's really fascinating here is just how successful that strategic pivot has actually been. They've moved from being, what we call a monoline lender, just focused on that one product, student loans, to becoming a fully diversified, digital-first national bank.
Yeah.
And this transformation, it's actually culminated in a really critical inflection point: sustained GAAP profitability.
It's profitability, right? That's the standard. A big milestone.
It really is. And this whole shift is driven by a powerful, kind of synergistic three-segment business model: lending, their technology platform, and financial services. They all work together. It's not just tweaking things. It's a complete reimagining of how they operate.
Okay, so definitely not just one product anymore. But how does this new integrated model actually, work to their advantage? You said it feeds itself.
Precisely. It's all about what they call their financial services productivity loop strategy. Think of it like a self-reinforcing engine, right? They attract new users, often with really compelling products from their financial services side, like maybe those high-yield savings accounts everyone talks about. And those users, they bring in low-cost deposits, which then provide cheap funding for SoFi's high-margin lending operations: personal loans, student loan refi, home loans.
So the savings accounts fund the loans.
Exactly. It creates this scalable, self-reinforcing growth engine. And the key is, it significantly lowers their customer acquisition costs over time. It's a true flywheel effect, just spinning faster and faster.
That does sound like a powerful flywheel. And a huge piece of the strategy, that had to be acquiring the national bank charter, right? Why was getting that charter so crucial?
Oh, absolutely crucial. If we connect this to the bigger picture, getting that national bank charter back in 2022, that gave them a profound structural advantage. See, before, as a non-bank fintech, they had to rely on more expensive, sometimes volatile capital markets to fund their loans.
Right, like selling bonds or getting credit lines.
Exactly. Now, with the charter, SoFi can gather member deposits directly through products like SoFi Money. And these deposits are stable, they're scalable, and significantly lower cost as a funding source. This directly boosts their net interest margin in the lending segment. That's the profit spread, basically.
So they make more on each loan because their funding is cheaper.
You got it. It gives them a significant competitive edge over those non-bank fintechs still relying on the old ways.
Okay, so looking at all of that, this big pivot, the integrated model, the bank charter, the profitability, what's the primary investment thesis for SoFi according to this analysis? What's the core message?
The primary investment thesis here is that SoFi represents a compelling long-term investment. It's seen as a category-defining digital financial services provider. It's made that tough transition from being a high-growth, cash-burning fintech to now a profitable, scalable bank. Its integrated ecosystem, that crucial bank charter, and its rapidly growing brand recognition, they all create this durable competitive advantage. And the point is, the market might not be fully capturing that value using just traditional banking metrics.
So the analysis is pretty bullish then.
Very. It gives a clear BUI recommendation and sets a 12-month price target of $26 per share, suggesting significant upside.
Okay, that's the big picture thesis. Now, let's really unpack this digital one-stop shop business model. You mentioned three distinct segments that work together. Can you walk us through them?
Sure. First up, there's lending. This is still their historical core, their biggest revenue source. It includes personal loans, student loan refinancing, where, as the analysis notes, they have an estimated 60% market share, which is just incredible dominance in that niche.
60%. Wow.
Yeah, it's huge. And also home loans. They make money here from the net interest income on loans they keep on their books and also from gain on sale. That's the profit when they originate and sell loans to other investors.
Okay, lending. What's number two?
Second, the technology platform. This is Galileo. SoFi bought them in 2020 for about $1.2 billion. And it's often described as the AWS of fintech. Think Amazon Web Services, but for financial back-end stuff.
Right, providing the infrastructure.
Exactly. Critical services like payment processing, card issuing, all done via APIs, application programming interfaces for other banks, other fintechs. This provides a stable, high-margin, fee-based revenue stream, and it's less cyclical than lending, which is a nice balance.
Okay, lending, tech platform, and the third piece.
And third, financial services. This is really the strategic glue holding the whole ecosystem together. It includes products like SoFi Money, their high-yield checking and savings. SoFi invests for stocks, ETFs, crypto, and the SoFi credit card. Now, while it does generate some revenue, mostly fees, what they call non-interest income, its main job is really strategic. It's about attracting and retaining members. It's the front door, the initial entry point that gets people into that financial services productivity loop we talked about. You start with savings, maybe get the credit card, then maybe a loan.
Got it. So it draws people in and then loops them into the other higher margin businesses.
That's the idea. Makes the whole ecosystem sticky.
So these pieces really do seem to work together. Given that integrated approach, where does SoFi actually stand in the market, and who are they really up against? It sounds like a crowded space.
Oh, it definitely is. SoFi is undeniably a leading digital banking platform. They're particularly popular with their target demographic, the Henry's high earners, not rich yet. They've grown to, what, 11.7 million members now? Pretty impressive scale.
Yeah, that's a lot of people.
And in personal loans, they're a major originator. Plus, that dominant 60% share in student loan refi we mentioned. But the competition is fierce and diverse. They're competing against other fintech lenders like Upstart or Lending Club. They're up against digital banks like Ally Financial. And of course, the giant incumbents, JPMorgan Chase, Bank of America, they're all pushing into digital too. Plus brokerages like Robinhood on the investing side.
So basically everyone.
Pretty much. It's a constant battle for market share, forcing them to keep innovating.
Okay, but let's talk about the numbers, because that seems to be where the real story of SoFi's transformation lies. This analysis highlights a dramatic shift, especially that recent turn to consistent profitability. What do the financials really show us?
Yeah, the income statement is pretty striking. You see explosive top-line growth. Total net revenue, it's been compounding at over 60% per year since 2020. That's the CAGR, the compound annual growth rate. Just staggering.
60% year over year.
For several years, yeah. And a key trend within that is the net interest income, the money made from lending. It surged from just 23% of their total revenue back in 2020 to over 54% on a TTM basis.
TTM trailing 12 months.
Right, the most recent year's performance. And that surge is a direct result of getting that bank charter and those cheaper deposits. But honestly, the most significant development, it's the inflection point, going from consistent, pretty substantial net losses to strong GAAP profitability in 2024. We're talking $479 million in GAAP net income.
Wow, that's a big swing.
It really is. It signals the business has finally reached a scale where operating leverage is kicking in. They're making significantly more profit as they grow, not just spending more to get bigger.
And the balance sheet, that must reflect this transformation too, showing where the growth and funding are coming from.
Absolutely. Total assets have ballooned more than 40 times larger since 2020. It's incredible growth. But the most critical trend on the balance sheet is that funding source shift we discussed, deposits. They've gone from basically zero before the bank charter to nearly $28 billion now.
$28 billion in deposits.
Yeah, that provides an incredibly stable, low-cost capital base for their loan growth. It really de-risks their funding compared to the early days.
So how does SoFi stack up against its peers? When you look at key financial ratios, profitability, efficiency, are they truly outperforming?
Well, comparing them is interesting because they sit between banks and fintechs. Their TTM net profit margin and return on assets look strong, especially when you compare them to, say, recent losses at Upstart. Their return on equity, or ROE, is around 7.2%, which is pretty impressive for a company that's only just turned profitable and is still scaling rapidly.
And what about debt? Banks usually carry a lot.
Right, but SoFi's debt-to-equity ratio is actually quite conservative for a bank, around 0.47.
Yeah.
Shows they're relying heavily on their own capital and those deposits, not just borrowing heavily. That's a good sign of stability.
Okay. Any other standout metrics?
Yes. Crucially, their efficiency ratio. It's currently at 53.0%. Now, for banks, lower is better here. It measures costs relative to revenue. And 53% is already better than peers like Lending Club and Ally Financial. It's actually approaching best-in-class levels for the entire banking industry.
And that's because of the digital model, no branches.
Exactly. It demonstrates the power of their branchless, all-digital setup. That efficiency is a core part of the long-term investment case.
Okay, this brings us squarely to valuation. How do you even value a company like SoFi? It seems to straddle these two worlds, part tech, part bank. There seems to be a real debate here.
You've hit the nail on the head. That is the core debate, and it makes valuation tricky. A thorough approach needs both intrinsic methods, like a discounted cash flow or DCF model, and relative comparisons. The DCF model in this analysis, which forecasts future cash flows and discounts them back, suggests an intrinsic value around $24.79 per share.
Okay, so that's one data point. What about comparing it to others?
Right, the relative valuation. And this is where it gets really interesting and where the debate really heats up. SoFi trades at a significant premium to its bank-chartered peers, like Lending Club or Ally, on metrics like price to book and price to sales.
Meaning it looks more expensive based on traditional bank metrics?
Correct. That premium clearly reflects SoFi's much faster growth and the market giving value to its technology platform, Galileo. However, its price-to-sales ratio is still a bit below a company like Upstart, which the market tends to value more like a pure-play tech company.
So it's somewhere in the middle. The market can't quite decide.
Kind of. It highlights that central question. Is SoFi just a bank using tech efficiently? Or is it fundamentally a technology company that happens to have a bank charter?
And what's the conclusion of the analysis on this? What's the aha moment for investors grappling with this?
The investment thesis, and what this analysis argues, leans strongly toward the latter view, that SoFi is fundamentally a technology company that strategically acquired a bank charter. That's the key aha moment. The thinking is, as Galileo, the tech platform, grows, and those high-margin, fee-based revenues become a bigger part of the pie, the market will increasingly assign a higher, more tech-like valuation multiple to the whole company. It's not just about net interest margin anymore. It's about the scalable tech ecosystem.
So the bet is that the market will eventually see it more like a tech company than a bank.
That's the core argument for the potential upside, yes.
Yeah.
That its identity is shifting in the market's perception.
Okay, so pulling that all together, the DCF, the relative comparisons, this tech versus bank perspective, what does it mean for the final valuation and that price target you mentioned?
Right, so synthesizing both the intrinsic DCF value, which was around $24.79, and this relative valuation debate. The analysis proposes a fair value range of about $24 to $28 per share. And the specific 12-month price target is set at $26. That's the midpoint of the range. And it implies pretty significant upside from where the stock has been trading recently.
Got it. And every compelling investment story has counterpoints. This analysis talks about SoFi's competitive advantages, its economic moat, but also highlights some pretty significant risks. Let's start with the advantages. What really sets SoFi apart? What's its moat?
Well, the analysis suggests SoFi is building what they call a narrow economic moat. Not a wide one yet, but it's developing. And it comes from two main sources. First, cost advantages. We've touched on this. That low-cost funding from the bank charter lets them fund loans cheaper than non-bank rivals. Plus, their all-digital model is structurally more efficient than legacy banks with expensive branch networks.
Lower costs on funding and operations. Okay.
Second, and this is maybe more forward-looking, emerging network effects. That financial services productivity loop we keep coming back to. The idea is more members mean more data. More data helps refine their lending models, personalize offers better, making the platform more valuable and stickier.
So the bigger it gets, the better it gets.
Potentially, yes.
Yeah.
That virtuous cycle where growth begets better service, which begets more growth, that's a powerful network effect if they can sustain it.
But you mentioned it's a brutally competitive industry. The analysis used Porter's 5 forces. How tough is the environment SoFi operates in, really?
Yeah, Porter's 5 forces helps map out the competitive landscape. And for SoFi, it paints a picture of intense competition. You've got a moderate to high threat of new entrants. While banking regs are tough, tech lowers barriers for niche fintech players. There's high bargaining power of buyers, that's you, the customer. You have lots of choices, and switching costs aren't always that high.
True. Easy to open another account online.
Exactly. Then there's a high threat of substitutes. Need credit? You can use personal loans, credit cards, buy now, pay later, home equity lines, many alternatives. And finally, very high rivalry among existing competitors. Fintechs, neobanks, big traditional banks, everyone is fighting aggressively for the same customers, especially those valuable Henrys.
Okay, so competition is definitely a major factor. Beyond that, what are the biggest specific risks or threats highlighted that could really derail SoFi's growth?
The SWOT analysis, strengths, weaknesses, opportunities, threats, points to key threats. That intense competition we just covered is a big one. Also, a potential macroeconomic downturn. A recession could lead to higher credit losses if borrowers struggle to repay loans.
Right, that's a risk for any lender.
Absolutely. Then there's always regulatory risk. Unfavorable changes from regulators like the Fed or the CFPB could impact their business model or costs. And cybersecurity risk is a constant threat for any digital platform. More broadly, you have to consider systematic risks like interest rate fluctuations, credit cycle risk, inflation impacting borrowers. The stock itself also has high market sensitivity. Its beta is around 1.7, meaning it tends to be more volatile, moving more sharply up or down than the overall market.
Okay, so it's not a stock for the faint of heart.
Probably not. Then you have industry-specific risks, primarily that regulatory piece and the relentless competition. And finally, company-specific risks. Execution risk, can they keep that flywheel spinning effectively? Credit underwriting performance, their models haven't really been tested through a severe long recession yet. And valuation risk, the current stock price, already bakes in high growth expectations. If they stumble or fail to meet those expectations, the stock could get seriously derated.
Lots to consider on the risk side then. So weighing all these factors, the transformation, the strong financials, the valuation view, and these risks, what's the overall outlook for SoFi? What are the key catalysts that could push the stock higher?
The outlook remains positive, driven by several potential catalysts. A major one is the expected student loan refinancing rebound. As a payment moratorium fully ends and people look to refinance, SoFi, with its huge market share, is uniquely positioned to capture a lot of that volume.
That could be a significant tailwind.
Definitely. Also, continued operating leverage. As revenue grows, profit should grow even faster because costs don't scale up as quickly. That margin expansion is key. Growth of the Galileo platform is another one. Landing more big enterprise clients there diversifies revenue into high-margin fees and reinforces that AWS of Fintech narrative. And, looking further out, a potential future cycle of falling interest rates. That would be a powerful boost for all their refinancing businesses, student, personal, home loans, by stimulating demand.
Okay, those are the potential positives. What about the main headwinds? What could realistically hold the stock back in the near term?
The biggest near-term threat, honestly, remains macroeconomic deterioration. A significant U.S. recession would likely hit loan demand and could increase credit losses, impacting their profitability.
The economy is key.
It really is, for any lender, especially one still growing rapidly. And the other major headwind is simply that relentless competitive intensity. They have to keep executing flawlessly because competitors are always nipping at their heels.
So, bringing it all together then. After this deep dive, exploring the pivot, the model, the financials, the valuation debate, the risks, the catalysts,
Yeah.
what's the final recommendation? What's the bottom line for our listener looking for that clear point of view?
The analysis concludes with a firm BUY recommendation. The core reasoning is that SoFi has successfully navigated a very difficult transition to become a profitable, regulated national bank. Its integrated model is clearly working. It's a proven engine for growth, delivering record member acquisition and showing a clear path to significant operating leverage and profitability. Yes, the valuation reflects high expectations, and there are real risks. But the company's demonstrated ability to execute its dominant positions in key niches like student loan refi and the sheer size of the markets it's addressing. It all provides a compelling runway for long-term growth. The analysis argues the market still doesn't fully appreciate the durability of its competitive advantages, especially that low-cost funding and the synergistic ecosystem. That's where the opportunity lies.
It really is a fascinating story. This deep dive into SoFi clearly shows how a company can almost completely reinvent itself, shifting from one identity to another, all while battling it out in one of the toughest industries. It really makes you wonder, if a bank can become a tech company, what's the next big financial innovation waiting around the corner? What's going to completely redefine how we think about money and banking next? Something to ponder. If you found this deep dive valuable and you want to stay ahead of the curve with expert analysis on these kinds of complex topics, make sure you subscribe to the deep dive. You'll get the fastest and most frequent updates. We'll be back soon with another stack of sources to unpack and make sense of, just for you.